Greetings, fellow traders. I'm Dylan, a research strategist at Pepperstone, presenting the latest weekly update on As Good As Gold. So over the past week, gold prices took a hit, dropping below the $2,000 mark yesterday. The unexpectedly strong U.S. January CPI data released last night or early today played a significant role in this decline. Traders are currently digesting this data and adjusting their exposure accordingly. So let's rewind a bit and take a peek at how gold's been doing against the US dollar in the last week. It seems like sellers have been driving the gold market in general, despite a couple of attempts by bears to push prices lower last Wednesday and Thursday. The back-to-back appearance of two dodgy candles showed a real tug-of-war between bulls and bears, leaving traders uncertain about future trends. Since last Friday, though, bearish momentum has picked up, with prices closing below the 5-day EMA for 3 straight days. This downward trend continued until yesterday when gold finally broke below the consolidation range of $2,002 to $2,066 seen since the beginning of the year, closing below $2,000 for the first time since December 13th last year. That's a single-day drop of nearly 1.4%. Now, if prices keep on sliding, buyers may step in around $1,981, a level that has served as both resistance and support in the past. If these buyers fail to turn the tide, we could be eyeing some support around the $1,930 to $1,940 US dollar range. Conversely, if there's a reversal, the $2,000 to $2,009 range could be a key resistance level for bulls to regain control. Well, as we've mentioned at the beginning of this video, the unexpectedly strong January US CPI increase is the main reason behind the decline in gold prices. Core inflation rose 0.4% month-on-month, the biggest jump we've seen in 8 months. This prompted a hawkish market reaction, with the 2-year U.S. Treasury yield surging 18 basis points yesterday, closing at 4.66%, with real rates climbing back above 2%. Meanwhile, the U.S. stock market experienced a pullback, prompting some demand for safe haven assets denominated in U.S. dollar. The US dollar index reached a new high since mid-November last year, cruising to 105 level. And with the Fed signaling they're not in any rush to slash rates, indicated by their recent communications with the market and the robust growth and employment data, well, that's just added fuel to the fire. I mean, maintaining a higher interest rate level for a longer period of time increases the opportunity cost of holding gold, putting pressure on gold prices. Moreover, investors' negative sentiment towards ETFs is another factor limiting the upside for gold. Gold ETF outflows have accelerated since the start of the year, totaling 1,932,000 ounces, equivalent to 2% of total holdings at the end of last year. As of last Friday, holdings hit a 4-year low. Coupled with the impact of the Lunar New Year holidays and the closure of major Asian markets, volatility might be amplified, with any unfavorable factors potentially dealing a significant blow to gold prices. So what's the bottom line here? In the short term, gold's got some hurdles to overcome, but the prospect of rate cuts this year, as well as the central bank purchases, can potentially give it a boost. Overall, the significant stronger than expected U.S. inflation data has given sellers absolute dominance in the gold market for now, while accelerated gold ETF outflows have also limited the upside for gold prices. In the short term, I reckon factors driving gold prices higher are relatively limited, but the rate cut narrative for this year and the central bank purchases are expected to provide support for the yellow metal in the long term. In the remainder of this week, we can pay attention to Thursday's January U.S. retail sales report, Friday's PPI, as well as the preliminary University of Michigan Consumer Sentiment Index. However, unless there is a significant deviation from expectations, we're likely to see this short selling trend stick around thanks to that hot inflation. So that's pretty much for this week. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading!